wonder, Lyn, if you might walk us through sort of that 1930-40 example to sort of refresh memories across the board of how, when you get into this ending period of the long-term debt cycle, how things start to function. I've heard you talk about this a few times, and I think the listeners would probably really enjoy that history lesson of the 30s and 40s and the attempt at yield curve control and what the implications are for today and whatnot. I think that would be very insightful.
Yeah, sure. And so one way I'd start by saying is that if you go back to the concept of the long-term debt cycle, the next step of understanding that is to realize that there's really two totally different types of debt. There's private debt and then there's public debt, and they can have very different implications for inflation and things like that. And so if you look back in the 1930s and 40s, first you had a private debt bubble. And so going into 1929, federal debt as a percentage of GDP in the United States, I use the United States for a lot of my numbers, but if you look at global numbers, most developed markets were generally on the same sequence, and just magnitudes were different based on different conditions at the time. But overall, you don't generally see markets on totally opposite sides of this, and so these things kind of tend to come in clusters. But so the 1930s, going into the 1930s, the United States has very high private debt. A lot of it was speculative, a lot of it was farmer debt, whereas federal debt was quite low. And then you got that 1929 crash, and then when you went into the 1930s, you started to get bank failures. You got declining GDP, and so in that 1932, 1933 period is when we really kind of hit the bottom. And so debt, private debt to GDP was extremely high. And they did start out with fiscal, policies, but in the beginning they were kind of moderately sized. They weren't enormous, but they were substantial. So the first steps there were to do something kind of like quantitative easing, in the sense that banks had gold reserves and then they had dollar-based liabilities. And so one of the things they did was devalue the dollar relative to gold, and that was essentially like quantitative easing, where you basically increase the amount of bank reserves in the system compared to their liabilities, and that helped stop that massive destruction that was happening with banks going under.
I do want to continue down that path. So I think what's interesting here when we think about global macro for everybody listening here is that we tend to feel like global macro is this long-term prediction of what's going to happen in the next 30 years, but really global macro analysts come in all shapes and sizes, right? People that are trying to analyze the next month, the next 6 months, the next year, the next decade. And I think from your work, Lyn, I think you're very clear as to your overall framework, but also making sure that you're watching the rates of change of all of these parameters before you position your tilts one way or the other. So you just kind of acknowledge that, and you're waiting for a particular change in the dollar and so on. What would the trades be that you're making in order, like either way? So if we see the federal government come in and put yield control, that means it's inflationary. You're an equity-focused individual. What is it that, what type of trades would you be looking to put in?
So basically, there's a couple major levels. So there's when it comes to the rates question and yield curve control question, some of the big ones we have are bank stocks, gold stocks or gold itself, as well as the value versus growth tilts, or the U.S. versus foreign equity tilts. And so, for example, if you expect an environment where they're going to let yields go up, we're going to have a continued steepening yield curve, then you're in an environment where you want to be into bank stocks, perhaps. I've been kind of somewhat bullish on them for a period of time here. You also generally growth stocks, they've been selling off recently because those yields are rising, and many of those growth stocks were very overvalued. And so I think a lot of people try to make too absolute of a kind of comparison. They say, in this environment, yields went up and growth stocks did fine, and therefore there's no correlation. Well, it's not that simple, because in previous cycles, for example, growth stocks were not necessarily overvalued, and so they were less sensitive to those rising rates. Whereas if you're in an environment where everybody poured into growth stocks because there's so much disinflation, yields got so low, they didn't know what else to invest in, so everybody just piled into all the tech stocks. It caused this huge run up, and then you start to get yields rising. Well, that puts a lot of pressure on those valuations, and so that's what we've seen recently, where you have bank stocks doing well, whereas some of those those hyper growth names have been correcting, and so as long as that trade continues, gold is somewhat in a corrective phase, growth stocks in a corrective phase, whereas value stocks, bank stocks, certain types of emerging markets or foreign equities are doing quite well. I've been bullish on a lot of the base commodities. Copper's been one that I've been riding, for example, recently kind of trimming that a little bit. And so that those are the types of trade I'd like to see from that, that more rising rate environment. Now, if you were to get a move on yield curve control, banks can still do reasonably well in that environment because they still have a positive yield curve. It's not like Japan where they have just a totally flat yield curve. However, when that yield curve stops steepening, that's less ideal for banks, and it suddenly becomes a lot more attractive for something like gold, because gold's closest correlation is real rates. And so if you look at the 10-year Treasury minus either the CPI or the inflation expectations, the break-even rates, that is a very strong correlation inversely with gold. And so gold does very, very well when real rates are negative. And so if you get that yield curve control environment where, let's say, inflation goes to 4% and the Fed caps yields at 2%, well, now you're at negative 2% real yields, and gold would love that most likely. And so gold stocks or gold, directly held gold can do very well in that environment, as well as some of those other base commodity stocks. And I would actually say that Stanley Druckenmiller gave a great interview the other month where he talked about he's kind of viewing it similarly, where his base case was higher inflation, and then his next question was, will the Fed intervene with rates or not? And so he says if they don't intervene with rates, then his play is short treasuries, and if the Fed does kind of come in and keep those yields from getting too disorderly, well, then he's long commodities because they would benefit from that that more inflationary environment with more negative real yields. And so that's a similar way that I approach as well, with the exception that I've been using long bank stocks for some of my basically the equivalent of a short treasury trade. It's a play on a steepening yield curve, and that kind of like the copper stocks that might have got a little bit of ahead of itself now, but overall that's the type of thing I want to be in if I expect steepening yield curve, rising rates, pretty strong economic growth.
Are you looking at you listening to the narrative in order to start shifting, or are you looking at technicals with the narrative?
So partially it's the narrative, but mainly it's quantitative data. So basically watching inflation play out, watching the growth of the money supply, watching what's happening in Congress, so watching the stimulus or lack thereof, and then seeing how that's going to play out in markets, and then watching Fed actions. Say, okay, are they going to purchase more to try to suppress yields, or are they going to let that run? So you have some central banks like Australia or the ECB that have been more explicit about their desires to keep the long end of the curve suppressed, whereas the Fed has taken somewhat of a more hawkish tone. Of course, it's all relative. So hawkish in the sense that rates are zero and that they're buying assets every month. But compared to some of their international peers, they're saying, we like a steeper yield curve. We're not going to, we're not that, you can read between the lines that they are watching certain levels or watching for certain things to break. But they're kind of, taking a more hawkish stance relative to some of their peers. And that's where you say, okay, at the moment, at least the trend change is higher yield, steeper yield curve, kind of ongoing corrections in growth stocks and gold and things like that. But then, if we do to get that pivot, that's when I'd be more interested in maybe looking at those growth stocks again. And I've already kind of monitoring some technicals as it relates to gold and things like that. And so it's that combination of some of those trend changes as well as technicals.